Good morning, everyone, and welcome to the Seraphim Space Investment Trust Q1 results webinar. I will shortly hand over to the Chief Executive, Mark Boggett, Chief Investment Officer, James Brugger, and Chief Operating Officer, Sarah Shackleton, to run through the results presentation. Once the presentation has concluded, we will open the floor to questions. If you do have a question, please use the raise your hand feature and we will take you off mute so that you can ask your question. I'll now pass you on to Mark to begin the presentation.
So, ladies and gentlemen, I'm pleased to present the highlights of the Seraphim Space Investment Trust first quarter results. So before we get into the results, I want to set the scene. The Seraphim Space Index is a publication that's released by the manager each quarter. It monitors private investment in the global space domain. And as reflected in the last edition, the private investment landscape witnessed a noteworthy rebound in the quarter ended the 30th of September 2023. So during Q3, private investment surged by an impressive 33%, reaching $1.6 billion. This is a substantial leap from the previous quarter. What's particularly encouraging is that this growth occurred alongside stable deal volumes. This indicates a robust and sustainable trajectory. The quarter marked a decisive return to expansion from US investors, and with a strategic focus on deploying capital into later stage and larger growth rounds. So these positive market trends were mirrored in the performance of SSIT during the quarter to the 30th of September, as evidenced by the 4% increase in net asset value. Across the portfolio, valuations demonstrated strength, with notable gains in D-Orbit, Leo Labs, and Hawkeye 360, each successfully closing investment rounds during or immediately after the end of the period. A positive foreign exchange position contributed to total portfolio value increase of £12.4 million. The SSIT portfolio fair value has now surpassed costs at 103%, and the level investment activity across 5 transactions remains consistent with the standards that we've set in previous quarters. We maintain an optimistic outlook on the capitalization of the portfolio, given that our private companies boast an average cash runway exceeding 18 months, and this is coupled with a robust £30 million in the cash reserves of the trust. Despite these positive developments, it's important to note that the share price discount to valuation continues to persist at near record highs. This discrepancy remains in focus by the board, especially in light of the positive news flow and the regular updates provided through the manager's monthly RNS newsletter. Whilst we acknowledge the existing discount, we anticipate that the improving economic outlook and the robust underlying fundamentals of our portfolio will gradually lead to a narrowing of this gap over time. We remain vigilant in monitoring the market dynamics, but we're confident that our strategic positioning will contribute to a sustained valuation appreciation. So before we go into the detail of the Q1 report, I just wanted to take a step back to remind folks about the big picture for Seraphim. So Seraphim is the most prolific investor in the space market globally, with a portfolio now of over 100 space tech companies across both our public and private portfolios. Seraphim was the first VC fund to focus on space in 2016, and the Seraphim Space Investment Trust represents the one and only listed investment fund focused on space globally. Our partners and backers include some of the biggest space corporates globally, and we continue to see a massive global deal flow. We're literally seeing virtually all deals at all stages, and this provides us with an information asymmetry that we use to make our investments. We triage deal flow between early stage and late stage deals, with the early seed stage deals going to our affiliated accelerator program. This accelerator, now the biggest of its kind in the world, is operational across 3 continents. We're a value-add investor. We're hands-on. We join the boards of most of the portfolio companies, and this allows us to be able to build conviction in these businesses so that we can consider how we support later rounds. Information asymmetry and conviction is the bedrock of our past and indeed future success. Now, let's turn to SSIT and the results for the first quarter. Starting with the highlights. So the NAV per share has increased by 4%, from 93 pence to 97 pence. The market has been pricing in heavy falls in valuation in our share price, with the discount standing at 55%. Net assets of 229 million are valued at only 103 million pounds by the market. The share price performance of SSIT correlates closely with our AIC peer group, as evidenced by the chart on the right-hand side. The Seraphim share price is the yellow line, the AIC peer group is the blue line, and this includes trusts like Chrysalis and Schiehallion. So during this presentation, I hope to convincingly explain why SSIT will be well positioned to close this discount gap when sentiment returns towards technology and growth stage private companies. SSIT has a number of clear and increasingly evidenced drivers that mark us out differently from the generalist tech nature of our AIC peer group. So let's delve into the detail, starting with the attribution analysis table. The value of the portfolio increased from 187 million to 200 million during the period. A total of 4.1 million of additional capital was deployed, and that was split between 0.9 million in new investments and the balance 3.3 million in follow-on investments. The quarter delivered 2.2 million of unrealized gains, together with 6.1 million of FX gains. But the highlight for the quarter was the portfolio value versus cost, moving from 97% to 103%. Next, let's turn to the balance sheet as at the 30th of September. This table sets out the NAV bridge. As you can see, NAV saw an increase of 6.5 million over the period to 229 million pounds versus 222 million, the opening position. Besides the 8.3 million pound increase in unrealized fair value of the portfolio, other contributing factors were the £1 million cost of the share buyback programme that was initiated by the board in July, and the management fees and expenses of just under £1 million. This means that NAV per share saw a healthy increase during the period from 93 pence to 97 pence per share. Importantly, I wanted to note that the portfolio is well capitalized, and we also hold 13% of NAV in cash to continue to support the portfolio in the year ahead. Next, turning to the investments. 5 transactions, 4.1 million pound invested. We've continued to make small investments, but for the purposes of today's presentation, I'm going to focus on the growth stage assets that can move the needle on NAV in both the short and medium term. The biggest investment in the period was a follow-on investment into the UK-based antenna manufacturer called All Dot Space. During the quarter, the business signed a large non-dilutive funding from a US defense customer, which was in excess of $10 million. In addition, during the period, Seraphim invested 2.9 million pro rata to other shareholders. A new chairman was also appointed, Mr. Chris Emerson, a respected former aerospace executive who previously served as chairman and CEO of Airbus's US defense and space business. I believe that this is another indicator that this company is really getting ready for prime time. Allspace is an important portfolio company to Seraphim. Ranked third in our NAV weighting, this company is at a pivotal point. They've just started to deliver their first customer orders for their unique antenna system. They have developed an electronic antenna specifically for moving platforms. These are the cars, the boats, the trains, the tanks. These can connect with any satellite and uniquely in any orbit. The company has a range of contracts with government defense customers eager to access this game-changing capability. It has defense customers in the US, in the UK, and Asia, along with commercial customers such as SES. Let me just spend another minute or two spelling out why all.space tech is deemed so important for defense customers, especially given the current geopolitical tensions. So Western governments are worried about the possibility of adversaries interfering both with their communication satellites and their ground-based antennas for receiving the communication from their satellites. Western militaries rely on satellite-based communications to operate effectively. Therefore, were they to be interrupted, to be hacked, for their signals to be jammed, this could have a major negative impact on their operational capabilities. All.space has unique abilities that enable them to mitigate this. Their lightweight, low-powered antennas can be fitted to any military vehicle, boats, planes, tanks, Humvees, etc. They've got a unique ability to simultaneously connect to several different satellites from different operators at the same time. So this provides their defense customers with much greater resilience, as it's now become possible for them not just to connect to their own satellites, but to commercial ones too, including the likes of Starlink with its 5,000 plus satellites, which are much harder for them to interfere with. Furthermore, All.Space's antenna itself is actually much harder to jam. In fact, it's even capable of identifying the source or location of anyone trying to jam its terminals, which is another unique and highly valuable capability of this product. To help put this into context, the scale of the opportunity this company is addressing, the likes of the US DoD has hundreds of thousands of vehicles, if not millions, that are all candidates for all.space's antennas. And these antennas sell for a six-figure sum each. So we're potentially talking about a directly addressable market opportunity measured in billions of dollars just in the defense market alone. Next, we turn to key developments during the quarter. It's interesting how closely SSIT has correlated with the trends highlighted in the Seraphim Space Index publication. In the quarter to the 30th of September, the standout feature of the quarter was the enormous amount of private investor funding flowing into the in-space logistics market. Most notably, these were the developments in the period that SSIT was best aligned with. Deorbit was the key driver for valuation uplift this quarter, increasing by 5.3 million on the back of closing an investment round outside of the period, and with the uplift in these results partly reflected in the terms of this new round, which are expected to receive Italian government approval to enable it to be completed before the end of the year. The company announced a first close of €100 million round led by a Japanese corporate called Marubeni. The business continues to develop its leading position in the space logistics market, recently completing its 12th successful space taxi mission, where they delivered 17 payloads into space for a variety of customers. They continue to consolidate their market position as the leader within the in-space transportation market. The exciting aspect of this business is planning to become the RAC, or the AA of space. Using its empty space taxi vehicles, once they've delivered their clients to their specific orbits, they'll then look to undertake a secondary business model, removing satellites that have reached the end of life, or they've broken, or need replacing to avoid leaving them as space junk. This is a market that will become increasingly regulated, with Deorbit providing the very services that the regulator will demand of companies seeking a license to launch. Last year, for example, the US regulator made an historic change so that satellite operators have just 5 years post the end of their satellites reaching their end of economic life to remove their satellites. Previously, that figure was 25 years. Closing this round is another show of strength for deorbit in the wake of its competitors such as Spaceflight and Momentous, who are actually going in the opposite direction. Deorbit is shaping up to become one of the leading companies in the European space arena. So keeping with the theme of in-space logistics, let's talk about Astroscale. So think about this business as the quick fit of space. They've also been benefiting from increased emphasis of regulation and government interests on the mitigation of space debris. Astroscale is the poster child for this emerging multi-billion-dollar industry. This company is literally hoovering up large government contracts as they become available. This quarter, that includes an $80 million contract from the Japanese government to evaluate and ultimately recover discarded fairings from an historic launch. They also closed a $25.5 million agreement by the US Space Force to build and deliver a prototype space vehicle able to refuel some of the US's military satellites whilst in orbit. Next, moving to Voyager Space, which is best described as a next-generation space prime. During the quarter, two major milestones developed. Firstly, Voyager and Airbus announced plans to commence a joint venture to create Starlab as a next-generation free-flying space station, which will replace the ISS when it's decommissioned at the end of the decade. Starlab will provide the facilities to host public and private astronauts, as well as forming the crucial infrastructure required to support research, development, and manufacturing in space. Importantly, this joint venture will allow the European Space Agency to support the program through customer contracts. Furthermore, as evidence of the increasing strength of the Voyager position, Northrop Grumman, another large space prime, announced that it will drop its own plans to develop its own commercial space station and instead assist competing compete and align their efforts with Space Voyager. Northrop's technical capability and proven success in the cargo resupply services. So, for example, they've already supplied 19 missions, providing resupplies to the ISS. This is going to play a pivotal role in accelerating Starlab's development. So finally, one of the Earth observation portfolio companies, Satellite View, they reached another major milestone. Their first satellite in orbit, which is now working and has now started to generate revenues. Now, this company is never out of the news. They recently garnered significant attention from renowned news outlets such as Sky News and the BBC. They're pioneering the use of proprietary infrared sensors from space, opening up a world of possibilities for understanding, monitoring, and resolving climate-related issues. What sets them apart is their groundbreaking achievement of providing building-level resolution from space commercially, a milestone that is generating substantial demand. To date, they've secured option contracts worth over $150 million in just the 6 months leading up to the launch of their first satellite. They're now making strong progress converting these option contracts into revenues. So this slide provides a snapshot of the portfolio. So looking at the left-hand side, drawing out some of the insights from the donut charts. Into the ecosystem chart in the top right, more than half the portfolio is invested in platform. This means satellite constellations. These are the businesses that are developing the digital platform in the sky, providing capability of data and insights from large fleets of low-cost satellites. The biggest customer today for these businesses is defense, given the considerable increase in defense budgets since the Ukraine war broke out. In relation to geography, it's pretty evenly balanced between the US, Europe, and the UK. And then in relation to stage, as the bottom left-hand chart indicates, 75% of the value is in the growth rounds of the C and D series. So moving on to the right-hand table, turning our attention to the NAV chart, the top 10 portfolio companies dominate NAV, accounting for 77% of total NAV, alongside 13% for cash. So in our last quarter, we went through each portfolio in detail, so we won't do that this time. I really just wanted to draw out ICEYE, which is our largest holding in the portfolio, 20% of NAV. So this is one of the portfolio companies where we doubled down based on a high level of conviction. And that conviction is now paying off as this business is performing exceptionally well on all measures. So this is the final slide before we open up to Q&A. So let me just review this conclusion slide. So the market stats show the investment in the sector is rebounding from lows of 2022. We've seen increased private equity investor participation, a trend that we expect to continue with the likes of KKR and BlackRock taking minority investment stakes, and we anticipate that other PE players will follow. Given the geographical tensions, defence budgets are now at record highs, and the PE investors are positioning themselves in companies that will ultimately access these visible, well-defined long-term budgets. The defence sector is buoyant and highly acquisitive, so we expect to see continued development in M&A. We also see considerable investment from climate and impact funds participating in equity rounds. With billions of dollars in dry powder in these funds, we anticipate a continued upswing in their interest in space-related innovation that addresses climate and sustainability issues. In the year ahead, we also expect sovereign wealth funds to become a feature of the market. They're both a customer and an investor as countries seek to develop sovereign capability in space. As such, we see these three pools of motivated investment capital as underpinning the continued upswing in volume and value of space-related transactions. In relation to SSIT, we consider that we are well positioned for the year ahead. The portfolio is well capitalized with 18 months of average cash runway across the private portfolio and a cash position of £30 million at the end of the quarter. So we thank you for your attention. Myself now and James Brugger and Sarah Shackleton will take your questions.
Thank you very much, Mark. As a reminder, if you do have a question, please use the raise your hand feature and we'll take you off mute. We have our first question from Giovanni. If you could take yourself off mute now, please, and we'd love to hear your question.
Great, thanks. Just checking you can hear me on your end.
We can hear you, yes.
Brilliant, thank you very much. Just a quick question on the strategy for deploying the remaining capital in the trust. So you mentioned in the full year results presentation about the strategy being sort of deploying capital in terms of syndication, reserving kind of majority of the remaining cash for companies with low syndication who need you to step in to provide funding. I suppose playing devil's advocate here, is low syndication in itself not potentially a negative market signal and reason to not deploy further capital? I mean, particularly in respect of VC investing, where we're expecting a number of companies to fail over time potentially. And I guess connected to that, how are you guys balancing the risks of potentially throwing good money after bad versus obviously the opportunity cost of not building larger positions in portfolio companies that are demonstrating clear momentum? Thanks.
Thank you, Giovanni. A great question. I'll ask our CIO, James, to answer that.
Yeah, so I think key point to clarify, Giovanni, in terms of where we're making a decision to invest, weak syndicate is not the determining factor. So it's obviously a consideration in terms of how reliant any given business is on our participation and at what level, but it's certainly not the only consideration. So To pick up on a bit more context of what we communicated in the annual results, we indicated that we had participated in a majority, but not all of the follow-on funding rounds that the portfolio had over the preceding 12 months. Worth noting that we also called out that really bucking broader venture capital market trends, we were very pleased that those portfolio companies that had raised money in the preceding 12 months, that a majority of those transactions had been led by new investors, quite unusual in the current climate. And number two, even more unusually, is that the majority of those funding rounds had been at increased valuations relative to their previous round, or what we were holding it on our books at. Again, another very positive indicator. So our companies have proven themselves to be very adept at continuing to access capital from both existing investors and new investors during a pretty challenging broader macroeconomic environment. Albeit, as Mark has alluded to, space tech generally has been an area that has really bucked the trends in terms of investment appetite because of the increasing demand that is coming from the defense and climate sector. So in terms of how we're thinking about deploying going forwards, we're being very discerning. It's on a case-by-case basis, and ultimately the overriding consideration in whether to participate in a follow-on round or not, or indeed to consider potentially any new investment opportunities, is our own view on how we can maximize shareholder value. And it's through a combination of those different transactions that we ultimately believe that we will be able to achieve that.
Thank you very much, James and Giovanni there. We have a couple of further questions, which I will read out now. The first one is, why do you think your portfolio has been able to attract investment where so many other companies are struggling at the moment?
Again, I'll ask James to answer that.
Yeah, I think I partially covered that in my previous response. So our companies have shown strong performance commercially, in terms of, again, the information that we've disclosed recently around the revenue growth across the portfolio, and perhaps more significantly the bookings growth. So we're seeing tangible evidence of the fact that our companies are now getting really significant demands, principally from governments, but not exclusively, for their capabilities. And as we've cited in previous quarters, that has translated into record bookings over the last 12 months for some of our most important companies, including the likes of ICEYE and D-Orbit. So in a challenging broader investment climate, there is generally a flight to quality, and investors are particularly looking for businesses that are showing tangible evidence of commercial traction. And fortunately, as the stats that I just highlighted showed, overall, our portfolio has been trending in a very positive direction, with some very, very strong secular tailwinds powering that momentum. And it's for a combination of those reasons, I believe, that new investors have been willing to look to participate in the funding rounds of our portfolio companies. And that is a trend that we would expect to continue over the year ahead.
Thank you, James. And one final question that we have. So you mentioned that you have reserved cash to support portfolio fundraisings as required in the year ahead, whilst leaving a modest sum for new investment until the market improves and more capital can be raised. Given that's the case, why did you choose to use some of your funds for a share buyback?
Can we ask Sarah to answer that question?
Thanks, Mark. Yes, so obviously we look at this on a periodic basis, and the board looks at it and considers the best use of cash, whether it be putting it into the existing portfolio, new portfolio companies, or a share buyback. And during the summer, when the discount reached a a very very high level, the board took the decision to undertake a limited buyback at that point of time, and will continue to consider the merits of doing a buyback on an ongoing basis.
Thank you very much. That marks the end of the questions, and I'll now hand over to Mark and the team for any final remarks that they'd like to make.
Great. Well, thank you for your time, everyone. We acknowledge the huge discount that the trust is currently sat on. Hopefully, you will have taken some confidence from the charts that we shared, where we showed that our performance is very correlated to our peer group. So we believe that the discount is not so much focused around Seraphim and Space. It's more around the general nature of investment trusts that are investing into private growth stage companies. We believe that we're very well positioned in a large addressable market. The companies that we've invested into are demonstrably the market leaders within the field. And hopefully from the narrative today, we've made it clear that there are three distinct large pools of capital that are motivated to invest into this sector, that are going to therefore continue to support our portfolio companies as they continue to raise capital as they scale in the year ahead. So we remain as confident as we can be about the outlook for the portfolio. We've very much got our head down, supporting these portfolio companies and helping them build and selectively investing into new ones. So thank you for your time today. Hopefully it's provided you some confidence in the outlook for this trust.